Silver fell 53%. Almost everyone is reading this wrong. Silver just did something that has only happened a handful of times in the last 50 years. It fell more than 50% from its high, and almost nobody is talking about what happens next. Quick question before we go further. If silver dropped over 50% from its peak and then suddenly started ripping higher again, would you call that a crash or the setup for the next leg up? Comment below. I actually want to know what you think, because here's what most people saw. Silver spiked to an intraday high near $121 an ounce. Then it fell and fell, down into the high 50s, hitting levels not seen since December of last year. Headlines called it a crash. Retail investors panicked. And on the surface, that's exactly what it looked like. But by the end of this video, you'll understand why the same drop that scared most investors out of silver may be the exact signal that professionals were waiting for. Stay with me, because the last part of this story is the part almost nobody is connecting yet. Let's start with the number everyone's afraid of. 53%. That's roughly how far silver fell from its recent high to its recent low. Peak near $121, trough near $57, $58. In percentage terms, that's one of the sharpest drawdowns silver has experienced in years. Pause for a second and think about that. A 53% drop sounds catastrophic. It sounds like the story is over. But here's where it gets strange. Silver is still up roughly 60 to 70% compared to this time last year. So which is it? Is silver collapsing? Or is silver still in the middle of one of its strongest multi-year runs in decades? Most people stop their research right here. They see the drawdown, they see red on a chart, and they close the tab. But the drawdown and the multi-year uptrend are not contradictions. They're the same story, told from two different timeframes. And understanding the difference between those two timeframes is exactly what separates retail investors from the people who actually make money in this market. Here's an analogy. Imagine a rocket launching. It doesn't go straight up in a smooth line. It surges, stalls, drops back a little as it burns through fuel and adjusts trajectory, then surges again even higher. If you only watched the stall, you'd think the rocket failed. If you watched the entire flight, you'd see the stall was simply the vehicle correcting course before the next stage ignited. Silver's chart over the past year looks a lot like that rocket. So what actually caused the 53% drop? This is where most explanations get lazy. They just say, profit taking, and move on. But there were three specific forces working together, and if you understand them, you'll understand why the setup right now looks completely different. Force number one, the dollar strengthened and expectations shifted toward the Federal Reserve raising rates instead of cutting them. When investors believe rates are going up, holding a non-yielding asset like silver becomes less attractive compared to holding cash or bonds that pay interest. That single shift in expectation pulled a wave of speculative money out of the metal almost overnight. Force number two. Industrial demand cooled slightly in certain sectors, just as the metal had become crowded with short-term speculative positioning. When a market gets that crowded on one side, even a small piece of disappointing data can trigger an outsized reaction, because everyone is trying to exit through the same narrow door at the same time. Force number three, and this is the one almost nobody talks about. The gold to silver ratio had become badly stretched, meaning silver had run up faster than gold, and a snapback was almost mechanically overdue. Markets like this don't move in straight lines forever. They stretch, and then they correct that stretch, violently. But here's where it gets interesting. Because right as silver was hitting its lowest level since December, something changed. New Federal Reserve Chair Kevin Walsh stood up on the world stage at the ECB forum in Sintra, Portugal, and said inflation risks have come down. Almost immediately, that one sentence started to shift the entire narrative that had been crushing silver for weeks. And then, on the very same week, the June jobs report landed. The US economy added just 57,000 jobs. Economists were expecting more than double that. On top of that, the two previous months were revised down by a combined 74,000 jobs. That is the weakest quarter of hiring in months. What would you have expected the market to do with news that weak? Most retail investors assume bad economic news is bad for everything. But watch what actually happened. The moment traders saw that miss, the odds of a September rate hike collapsed from around 67% down to below 50%. And when rate hike odds fall, the appeal of holding gold and silver goes up, because the opportunity cost of holding a non-yielding asset drops with it. Silver didn't just stabilize, it surged. From the low 50s, back above $60, then pushing past $62, $63 an ounce within days. That is not the behavior of a market that is broken. That is the behavior of a market that got violently shaken out and is now snapping back with real conviction. If you're finding this useful, hit like right now. It genuinely helps more people find this kind of analysis, instead of the surface level headlines everyone else is putting out. Now here's something most people are completely missing, and I think it might be the most important part of this entire story. While retail traders were panic selling into the low 50s and high 50s, the physical silver market was quietly restructuring itself in a way that hasn't happened in decades. In its most recent newsletter, the Silver Institute highlighted the launch of a new physically deliverable silver futures contract out of Singapore, run by the ABAX exchange. This is a US dollar-denominated contract requiring actual delivery of ultra-high purity silver into vaults in Singapore, including facilities run by Brinks. Why does this matter? Because for decades, the global silver price has been set primarily through paper contracts on COMEX in New York and through the London market, venues where the vast majority of contracts are settled in cash, not in actual metal. A new, physically backed pricing mechanism emerging in Asia, right where the heaviest industrial demand for ultra-pure silver in solar panels and semiconductors actually lives, is not a small detail. It's a structural shift in how silver gets priced globally. Think about what that means. If a growing share of price discovery starts happening through contracts that demand real, physical delivery, it becomes much harder for pure paper positioning to push the price around disconnected from what's actually happening with real supply and real demand. Most investors watching headlines have no idea this exchange launched. Professionals watching structural shifts in market plumbing noticed immediately. That's the gap between retail information and the information that actually moves markets long term. But this isn't even the biggest story developing underneath the surface. Because at the same time all of this was happening, central banks around the world continued accumulating gold at a net positive pace through the first half of this year. And when the dollar softens, the way it has recently, that reduces the opportunity cost for central banks and large institutions to keep adding to both gold and silver holdings. So let's put the full picture together, because at first this doesn't make sense unless you connect every piece. Silver ran up too far, too fast on speculative positioning. The gold-silver ratio stretched to an extreme. Rate hike fears and dollar strength triggered a violent 53% unwind that scared retail investors into selling near the bottom. At almost the exact same moment, a new Fed chair signaled inflation is cooling, a weak jobs report crushed rate hike expectations, and a brand new physically backed futures exchange quietly went live in Asia, changing how silver gets priced from here forward. That is not the story of a metal in decline. That is the story of a market resetting its foundation before its next move. Would you have expected all of these pieces to be connected? Most people wouldn't, because financial media reports each of these stories separately, as isolated headlines, instead of as one connected, structural shift. Now, I want to be careful here, because I'm not in the business of making promises. Nobody can tell you with certainty what silver does next week or next month. But here's what we can say with historical grounding. If rate cut expectations continue building the way they have after this jobs report, and if inflation data continues coming in soft, the way Chair Walsh suggested, the conditions that historically support higher silver prices start stacking up. If the physical delivery market in Asia continues growing in influence relative to paper markets in New York, that historically tightens the gap between paper price and real-world supply and demand. The probability of continued strength doesn't guarantee it, but the math is starting to point in a specific direction. So here's the real question underneath all of this. When most investors saw a 53% drop, they saw a warning to run away. But when you look at the entire picture, the drop looks a lot more like a stress test the market had to pass before its next chapter could even begin. This isn't simply about a $5 or $10 move in silver. This is about whether the way the world prices precious metals is quietly shifting away from paper contracts in New York and London toward a system with more real physical backing. And if that shift continues, it changes the entire relationship between paper silver and physical silver going forward. So here's the question I'll leave you with. Are we watching another temporary scare that resolves back into a boring, sideways market? Or are we watching the early stages of a much bigger structural shift in how gold and silver get priced globally? What happens over the next few months could end up mattering a lot more than most people currently realize. If you made it this far, you're already doing more homework on this than the vast majority of people trading this market right now. I'd genuinely love to hear where you land on this, so drop a comment. I read every single one. And if you want more breakdowns like this, cutting through the headlines to what's actually moving gold and silver, subscribe and turn on notifications. Because based on everything lining up right now, the next few weeks could turn out to be a lot more important than they currently look. Sometimes the biggest moves in this market happen quietly, long before the headlines catch up. This might be one of those times.